Major funding for these broadcasts has been provided by grants from New York Community Bank, M&T Bank, PBM, Customers Bank, Collins Building Services, AmTrust Title Insurance Company, Marks Paneth, Capital One Bank. Additional funding for these broadcasts has been provided by grants from Amerant Bank, Bank of America, Citizens Bank, Dime Community Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC Handler Real Estate Organization, Hodges Ward Elliott Inc., Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Catsimatidis Red Apple Group, Keysight Capital Partners, New Banks, Meridian Capital Group, Ocean First Bank, People's United Bank, RPW Group, TD Bank, and these friends. Boy, oh boy. Everybody thought the COVID-19 was going to be all over. Everything was going to be great. Come Labor Day, everybody's coming to work. Restaurants are open, gyms are open, bars are open. All of a sudden, that's not really happening. So what effect has COVID-19 and the Delta variant had on investment sales? I've been able to assemble 3 dynamic investment sales executives to provide their insight on that subject. My guests include David Schechtman, Senior Executive Vice President at Meridian Capital Group, Meridian Investment Sales, Shimon Shakori, Founder and President of Ariel Property Advisors, and last but not least, Seth Glazer, who is a Senior Vice President at New York Multifamily, Marcus & Millichap. Mr. Schechtman, what's really going on? Has sales been well? Are we still in a tight time?
Michael, brokers are perpetually optimistic, and we have to remain that way. If I could define the market, and obviously during this call with these wonderful colleagues, we'll get into deal specific and numbers, but it reminds me of the REM song from the late 80s, early 90s. Everything is pushing elephants upstairs. It is difficult to make deals. However, we're doing exponentially better than we were during the abyss in 2020. We are all busy. Thankfully, we are all closing deals. Volume continues to increase. Very laborious to get anything across the finish line.
I had the opportunity to speak to Seth yesterday, and Seth was exceptionally optimistic, maybe because he's the youngest of the crew over here. But Seth, you were saying your investment sales, the team that you're working on and the properties, because you specialize in Upper Manhattan and the Bronx, are really doing well.
We're really doing well. Citywide in 2021, we've sold 49 apartment buildings so far this year, and we have another 30 some odd in contract to close over the next couple of months. Really, I think since everybody started getting vaccinated around April, you've seen the market really pick up significantly in terms of pricing. COVID started going away, and then obviously it's come back a little bit over the last 30 or 45 days. But you've seen the rental market have a lot more clarity this year than you did towards the end of last year around New Year's. And we've seen prices tick up rather significantly. Buyers are coming out of the woodworks and meeting the market. So something that was sitting on the market for 90 days, where you were 5 or 7% away, is now being sold. So we like that. We feel very good about that. There's a lot of money on the sidelines, and we're seeing velocity really tick up tremendously.
I concur with both my colleagues. I'm a lot more optimistic than most, but the numbers talk, right? So if you look at the first 6 months of 2021, we had about $8 billion of transactions. And if you look at 2020, that's still not the annualized $20 billion that we need to be at. If you look at quarter by quarter, you see that the second quarter was about $6 billion versus $2 billion in the first. And that's exactly what Seth was describing, which is more deals are getting into contracts right now. And that's really what we're seeing. Unemployment is half of what it was. Vacancy factor, if you look at vacancy compared to where we were last year, where we're at 3.5% versus 5.1, that's a dramatic drop. Even the condo market is doing well. The last quarter, condos in Manhattan sold 3,300 units, and that's the third most robust quarter in the past 10 years. So I think all in all, we're in the middle of big recovery. And you mentioned the Delta variant, something that we can pay attention to and talk about. I don't think we're slowing down a lot because of the Delta variant, and I can explain why. But I do think that we've gone through a lot of good stuff throughout the first 6 months of the year. One thing to mention, Seth was touching on contracts, and I'm sure David has them too. We have about 70 buildings right now in contracts in about 4 or 5 different portfolios. And that tells me that between now and year end, the velocity is going to increase and probably be at the same level of last year, if not better.
Talk to me about your thoughts about the Delta variant and its effect.
Yeah, so I think that the Delta variant is definitely going to affect some groups, right? So tourism, hospitality in general are going to recover a lot slower because of the Delta variant, unfortunately. But I think that it's not a black swan. We had a black swan with COVID. We know what it is. We've been through it. We're a lot more resilient as people. And I think moving forward, the recovery might slow down a bit, but it's not, in my opinion, it's not going to stop. Looks like the health concerns that are out there, people are getting the third vaccine. Eventually, we'll all get the third vaccine. Delta variant puts a little bit of a slowdown on that recovery.
What's your involvement today with the hospitality industry? Okay. I've seen that the room rates are relatively up. They're significantly up as compared to last year. Okay. Certain hotels being in foreclosure, but are you seeing any new hotels being done? Is there any trading taking place in the hospitality market? David?
Multifamily, you have 2 family wizards on the call, and on my team of just under 36 folks, I really am not the lead for all of our multi. I focus more, as you know, in the redevelopment, retail, Class B office, and development sites. We're in the market on with a hotel at 16 East 32nd Street. It's an 80,000 square foot building with 100 keys. It's called the Avalon, just outside of Koreatown. We've been in the market for a year, and we're asking a very high price per foot in my opinion. I would say in the past 90 days, I've signed more confidentiality agreements and had more walkthroughs with more previously unknown buyers, really exotic places, Asia, South America, Chicago, who are coming to the city. And this perception that hospitality is so terminally ill that we may as well get in now and pick it over like vultures, it's a fallacy. You haven't seen a lot of hospitality trade in the city proper because so many of them were wrapped up in workouts. Now that the occupancy and ADRs are ticking up materially, I think interest has only doubled or tripled. I wish I had more hotels, whether they were union or not, on the market. I mean, they're moving quicker than the retail that we have in Soho. But I still, if you ask me which asset class over the next year or two, Michael, is going to be the most exciting, I think it's multifamily and the continuation of industrial, which really has fundamentals, both of them, that can support them for years to come.
Here's a question with regard to land. Okay, development sites. Okay, since this is more of a specialty on Shimon and David as opposed to Seth. Where do you see land trading these days? Development sites.
Up and away. You take it, Shimon.
No, it really depends on where, right? I mean, we just, Sean Kale in my office just closed a deal in Brooklyn. It's on North First, and he closed it for about $400 a buildable foot. Now, the buildable was very small, 33,000 square feet. Can tell you that right now we're working on a bigger deal in downtown Brooklyn with Mike, Sean, and Jonathan. And I can tell you that the price per buildable there is going to be completely different and definitely below 400. And the reason is when you have 250,000 buildable, it's harder to build a condo or get a condo loan. And so it has to be a rental with MIH, et cetera. So it really depends on where you are. We're now marketing another deal uptown on Bennett, which is the second or third or fourth time we're marketing it. And we're about to send contracts out a little north of $100 a buildable foot because of a terrain. So it really depends on where we are and where you are. If you look at different other locations in Upper Manhattan, we're around 200 a buildable. If you look at Manhattan below 96th Street, you're around 500, which I think, by the way, Manhattan below 96th Street is going to be probably an opportunity for many developers moving forward at that price.
So
David?
here's a question for all three of you. New governor coming in, what effect is that going to have on the real estate market?
I think, okay, so my initial reaction on this is the thing that we had going for us with Cuomo is that he hated de Blasio. And aside from the rent laws, you know, if de Blasio said left, Cuomo said right. Now you've got an unknown. And I think that's going to could create a little paralysis amongst people to see once, you know, you're going to have the new mayor now with, in all likelihood, Adams, and then the new governor is a little bit of an unknown. And I think people might pull their foot off the gas a little bit to see what.
I understand the logic, but I don't think that's what's going to happen. I think what we've learned, especially since 2019, with the draconian changes to the rent laws, I think that city council and the mayor actually hold more sway. I think that the governor makes macro moves, but it wasn't the governor who instituted good cause eviction in Albany, which we know is going to trickle down. I think even with Eric Adams, the idea that I think 30 some odd of the 50 plus or minus city council seats are up for grabs in the next 12 months. That's what keeps me up at night. I think we're headed for good cause eviction. I think we're headed for market rate regulation and other socialist, left-leaning, anti-commerce regulation. That's what really keeps me up at night.
You know, the rent regulation is the biggest thing. I think that's the danger that over there, you know, you have Kavanaugh still in control. Okay, there's not many changes over there. I'm a little worried about, you know, what's going to happen. I mean, it's an open court. Shimon, you know, you've been involved with sites, and I've known on the subject of bioscience. It's the hottest topic today. Everybody wants to be in the bioscience. There's no vacancy. And I believe you were involved with the Tasty site, correct? Up in
That's
Upper
correct.
Manhattan.
We raised equity for that site.
Right. So how do we see the office market and the bioscience market? Are office buildings selling today? What's the status on that? Or I see, you know, when I'm reading some of the rags, it says instead of selling, they're being in foreclosure.
In terms of bioscience specifically, there are very, very few locations in the city. One of them is Tasty that offer brand new, so to speak, bioscience lab space that can be built by an owner. So I think if you own, you know, for those who own these kind of buildings, it's definitely an advantage. I think in general, the office market is a tale of location and quality. So if you look at what traded in the first 6 months of the year, one example is SL Green trading their building on West 20th and 6th Avenue, where they had quality retail and quality office, 80,000 square feet leased or released by a tech company. And on the ground, they had Microsoft and Staples. So, and the sale was about $1,400 a foot. So quality is definitely selling in the office market, and quality is renting in the office market. So if you look at One Vanderbilt and you see what they're getting there on a price per foot basis for their leases, they're getting great numbers. And the groups that will not do as well are the B and C buildings around them in Midtown. So I think it's a tale of different quality and locations that you have to look at when you look at the office buildings in general.
I think the B and C buildings have a difficulty being sold today, okay? You
Yep.
know, the tenants aren't going
And
in
rented.
there. Many of them are staying at home if they have to, because, you know, as opposed to having a small office in a building off West 38th Street or, you know, close to 9th or 10th Avenue, there's no real interest. So I think we see that over there. Seth, as I was saying before, you've been very active in the Bronx. How do you see, what's happening in the Bronx?
There's a lot to say about the Bronx right now. The velocity has gone up significantly. The prices have gone up actually rather significantly over the last couple of months. And the most interesting thing, I think, is that you can have a bigger building in the Bronx can sell at a higher price than a smaller building in Upper Manhattan. And I think that's crazy because that's never happened before, but we've seen several examples of it throughout this year. And bigger buildings in general, bigger, clean apartment buildings with elevators are selling in 2 seconds. They're very easy to sell. The smaller mid-block buildings in B and C locations are a lot more difficult to sell. The demand is less. If they're not clean, if they need new boilers, new roof, capital expenditures, there's significantly less demand. You know, right after the rent laws changed, the quality of the real estate, the quality of the asset started to matter a lot more because the boiler for a 20-unit building, it costs the same to replace a 60-unit building. So there's a lot more capital allocated to the bigger buildings. And in the Bronx, what you have is a history of familial ownership. And what I mean by that is you can have a person that owns 2 or 3 or 4 apartment buildings in the Bronx who's not necessarily active or wouldn't be on like your top 10 list of like, okay, who should I call? But they might find a building across the street from their office or 2 blocks away from one they already own, and they will pay. These people will pay top of market, and they're going to pay more for that building than they would for a building in Harlem or Washington Heights. And that I think is totally different than historically.
Seth brings up
Shimon?
a good point. He brings up a good point about the expense side of the equation. And what I found specifically in the Bronx is that if you have a long-term tax abatement in the building already, you don't have to go to city council to do that. You actually get an advantage. So for example, we have a building in Castle Hill that's in contract right now with a long-term tax abatement, and as Seth alluded to, it's a very low, around a 5 cap in the Bronx fully rent stabilized building. The other thing that you'll see in the Bronx in the coming months are a lot of closings specifically for affordable housing, project-based Section 8, for example. We have a Soundview deal that's in contract. We have a Morrisania deal that's in contract and a few others. And so I think the Bronx is making a lot of affordable housing plays there that we haven't seen before. And I think a lot of it is going to clear out in the next year or so.
Yeah.
David, you were born and bred in Brooklyn originally, so why don't you tell us what your thoughts about investment sales in Brooklyn in general,
Can't get
including land
enough.
sales?
Can't get enough of it, but I want to touch on just 3 things that we spoke about. Couldn't possibly agree more with both Seth and Shimon when it comes to a flight to quality. We're in the market on some multifamily buildings in Manhattan, another one in the Bronx. And what I'm finding is the paperwork going back not just 3 or 5, but 7 to 10 years, proving that you've actually made the improvements that you stated that you have. I have never seen this level of scrutiny for deals, really even as little as 10 million, but certainly once we get into the 50s and the hundreds, to the extent that they are even on the market these days because they're flying off the shelf. The level of scrutiny is tremendous, but they sell quickly. When you talk about Class B office and biosciences and new uses, fortunately, about 10 years ago, we started making tremendous inroads into New Jersey and Nassau and Suffolk County, and even, all about 50 miles out of the city. We have a contract going out for $48 million on a 171,000 square foot medical office building in northern New Jersey right now. This building was worth probably 25% less 3 years ago. What we have found is there's incredible allure to office and specifically medical uses that are within 15, 20 minutes of Manhattan. The values there have gone up the way that the Garment Center Class B and C office buildings have gone up, because the belief is folks are going to populate them quicker and the rents will rise. When it comes to Brooklyn, I think my mantra is I can't get enough. I just can't get enough of Brooklyn. We just shook hands on a deal in Brooklyn Heights on Clark Street. I happen to have sold the building back in 2007, and it's an exponent of obviously of what people paid for it. I think Brooklyn, you can actually dip a little bit on quality, and I want to carve out really unique places like East New York and Brownsville. But other than that, generally, can't get enough of it. I would take a Brooklyn building over a 5-cap Soho deal any day of the week if it were retail.
Yeah, Michael, you and I were talking about this yesterday actually on the phone, but we've had a ridiculous amount of activity in Brooklyn, specifically like Brownstone, Brooklyn, Williamsburg, Cobble Hill, et cetera, Carroll Gardens. And the smaller buildings in Brooklyn are flying off the shelf. So the tax class protected buildings, 10 units and under, you get all sorts of people coming out from all over the place who want to buy these things. Specifically, even better is the buildings 6 units and less, where if you're statutorily decontrolled, there's just a flight to, I don't know if safety is the right word, but it's how am I least likely to get screwed is really what people are thinking about when they look at these buildings. So they don't want to deal with rent regulation, and they want to know that their taxes are going to stay where they are. And those are your property tax increases are your biggest value killers.
Who's buying? We have institutional buyers again? Okay, do we have foreign capital? Who's making the decisions? Who's buying? Or are we having the families, as we would say, are buying?
I think the families are back in earnest. They're picking and choosing. And to one of the points made earlier, if it's across the street, or if there's efficiencies, if there's a family with 10, 20, 30 buildings, and you fall within their 5 or 10 block radius, boy, they're going to overpay. But Seth alluded to the tax class 2A and 2B, and I am confident that all 3 of the brokers on this phone are speaking with 2, if not 3, real big private equity firms and their operating partners. If you would have told me 5 years ago that one of those 3 groups would be executing deals in between $2 and $10 million 5 or 6 times a month, we would have had a belly laugh, because these are folks who like to put out a minimum of 25 to 50 million of equity at a time. So families, yes. Institutions are back in New York in a big way, not just for the 200, 300, 400 million, but they're buying different assets. They've reconfigured their investment format, and they're doing surprising things. And it's a pleasure to deal with them because they have oodles of cash. And then, yes, I made a joke earlier, but we're seeing first-time entrants and folks who divested themselves of their warehouses in the Research Triangle in Carolinas and Princeton, New Jersey, coming in, and they're really the only ones who are buying 4.5, 5 caps from us, because they're saying, you know what, I've traded out of Class B, give me a slice of the Big Apple. So I think you're seeing activity from all types of buyers, but I think the most important thing is it's very asset driven.
Yeah.
Shimon, you were going to say something.
No, I agree. I think that larger institutions who are buying the 2Bs and 2As and looking at it almost like a single family portfolio just in New York City. We also see local operators using all the new money. We see high net worth, we see family offices that are coming mostly for the multifamily with sometimes predominantly rent stabilized. We also see mission driven capital when it comes to affordable housing. I think more of that is out there today. That's usually financial institutions that have an additional need to invest, not just the return. So be it real mission to preserve affordability or CRA credits and so on. So these are the some of the buyers we're seeing. We do see international buyers, and I can tell you that many of them are in LP positions and smaller positions, so it's hard to see them actually in the deals. But from speaking with local operators that take their money, so to speak, they do tell us they have some new international money coming in from different places.
Who's providing the financing? Is it the signature banks? Is it the New York Community Bank? Is it JP Morgan? Who do you see as the major source of capital today?
Everyone.
Yeah, it's everyone. What we've noticed on the multis sales, like your mid-market, cookie cutter apartment building, it's mostly the big three: Signature, NYCB, and Chase. They've been gobbling up most of the business. But David, I mean, you and Shimon, you guys are working on other asset classes. Like who's lending on like a site right now? Where are people going for funding on that?
So I agree in part. I have to be very careful with what I say, certainly sitting in Meridian's main offices now in Battery Park City. We've moved our group here. I have 200 folks right downstairs from me who would argue that there are limitless banks. But I tend to agree, Seth. I think some of the usual suspects continue to dominate the multifamily space. What's fascinating, however, is on the kind of transitional loans, construction loans, project loans, what was a year ago a short list of 5 or 10 people has blossomed.
Okay.
There's just a ton of money out there.
My crystal apple is here. Based on this discussion this morning, it's very shiny. Okay. And it's going to only get brighter over there. And I'd like to thank my guests, Mr. David Schechtman, Shimon Shakoury, and Seth Glazer, and I'll see you next week.
Thank you.
Thank you.
Thank you, Michael.